Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to the Better System Trader podcast. This is episode number 162 and I'm glad you could join us today for a discussion on what is probably one of the most popular topics in trading, and that is entries and exits. Well, exits maybe not so much, but traders love talking about entries and love researching entries. But the truth is, when you dig a little deeper and start testing them out, you might just discover that lots of entries and exit techniques either don't actually work very well at all or don't work as well as expected. So, how do traders know what makes a good entry or what makes a good exit? How do we go about building effective entries and exits for our trading strategies? Well, in this podcast episode, we dig a little deeper into entries and exits with special guest Kevin Davey. Kevin has just released a book on entries and exits, so we're going to dig into that a little and discuss a number of other aspects of entries and exits too. And some of the points you'll hear us discuss today are: what makes a good entry? Is it logic? Is it symmetry, indicators, patterns, or something else? How do we test the effectiveness of an entry to determine if it's actually any good? Kevin also shares an unexpected way to use entries that could radically improve your trading strategies. We also discuss the hidden dangers of combining and optimizing exits, a simple technique to determine if you could be optimizing too much. Kevin's going to share where to find enough entries and exit ideas to keep you busy for a whole year. Plus, we'll talk about a whole lot more. So let's get started with my chat with Kevin on building effective entries and exits. Hi, Kevin. Welcome to the show. It's really great to have you here again.
Well, it's great to talk to you, Andrew.
Now, you've been on this podcast a number of times already, and it's always really good to have a chat with you. Plus, I think the topics that we're going to discuss today will really interest a lot of traders. But before we even get to that, I'm sure most listeners already know who you are and are aware of your work. But just to give us a little bit of context, and for any new listeners, can you give us a quick bit of background on yourself?
Sure. I'm in the U.S., and I've been trading for probably over 25 years now. A lot of that was on a part-time basis, kind of a hobby trader. And then I think it was about 11 or might be even 12 years ago now, I was able to make that leap from part-time trader to full-time trader. And part of the reason I was able to do that was because I had success in a trading contest, a worldwide trading contest, where I was up against some really good traders. And I was able to finish first or second place 3 years in a row. 1 year I won first place, and the other 2 years I came in second place. And that kind of convinced me that, hey, maybe I could do this full time. And so I was lucky enough to have a supportive spouse who said, yeah, that's okay. You can quit your job and become a full-time trader. So I was able to do that, and I've been doing that ever since. And in 2014, so almost 5 years ago, I had a book come out. It was called Building Winning Algorithmic Trading Systems, which kind of documented my whole testing and development process for building strategies. And based on that book, I had a lot of people kind of contact me and say, wow, can you teach this? And so then I started teaching people how to build their own trading systems. And so in addition to my own trading, which is probably my main focus, I also do quite a bit of teaching of others. And since that point in 2014, I've released a couple more books, shorter books, on different aspects of algo trading. And I continue to trade today and continue to also help people kind of improve their own trading.
Yeah. Now, speaking of books, one of the reasons why you're here today is that you've recently released a new book that we're going to talk a little bit about. And the title of the book, let me get it here. It's quite long. Entries and Exit: Confessions of a Champion Trader 52 Ways a Professional Speculator Gets In and Out of the Stock, Futures and Forex Markets. Why did you decide to publish a book on entries and exits?
A couple of reasons. One thing is, I always look at the feedback that people give me, both via email and on review sites. For example, Amazon, people that review my book. And what came through with people who reviewed the first book is, well, hey, it's nice. It gives us the process, but it'd be nice if there were some examples and more ideas out there of what we can build systems with. And I get a lot of that too with students who take my workshop. The biggest thing that people come into it lacking are ideas. And people just say, oh, I can't come up with ideas. I don't know what to test. And what do I use for an entry? What do I use for an exit? And so this book really was geared towards those people. So it kind of works for beginning traders who want to test some things that have worked for me in the past. And it also is for more advanced traders who already have tested a lot of things, but might be running dry of some ideas and they want to get some fresh ideas in there. And that's kind of what this book is all about. It's more than a book that you read and put away. It's more of a kind of workbook or a reference guide where you can keep going back to it and, for example, test a different entry or exit pretty much every week. If you do one a week, you'll take a year to get through this book.
Yeah, one of the things I really liked about the book is that you included exits in the book. And, I think there seems to be so much focus on entries and not so much on exits. Why do you think entries are so popular compared to exits?
Well, the big reason I think is because entries are really the only thing that as a trader we can control, or at least we feel we can control. And what I mean by that is you can be looking at the market and say, well, hey, I'm not going long until the moving average is like this and the closing price does this and I see this candlestick pattern. There could be a whole bunch of different things potentially, but when I see all those things, then I know it's time to buy. And I'm not going to do it unless that happens. And that you get a feeling of control, right? Because you think, hey, I'm making the market do what I want. Where for the exits, it's a little bit different. You're in the trade already, and the trade, you kind of feel, well, it's going to do what it's going to do, and you don't have as much control. At least that's kind of my thought process. But people just like entries better, and that's in the book. The entries outnumber the exits by about 4 to 1. And I think I got 40 some entries and like 10 or 11 exits, I believe. And the reason is people just like entries a lot more.
Now, for entries, do you think that they need to have like a logical reason behind them? Do they have to actually make sense to be a good entry?
I personally like that when, it has some logical basis. A lot of people use machine learning or some of the software that's out there that will just randomly pick indicators and build systems. And, it'll tell them that, hey, if the moving average, the 22 period moving average is greater than the 49 period moving average, oh, it's a great time to buy. Well, yeah, some of that, maybe that's real. Maybe it's not, but some of that is just data. It's just going to happen in data where you just get these spurious things happening that have no meaning. And that's why I prefer to have something where you actually think about it and kind of makes logical sense. So whenever I look at entries or exits, if I see something where for an exit, for example, if the stop loss is $862, I get a little scared. But if I see it's 750 or 1,000, then I'm like, okay, well, you probably didn't optimize it. Because that's, one of the fears is if you optimize enough things, you're going to find something that works really well. But it doesn't mean it actually is going to work going forward. So I tend to like things that make logical sense. But that being said, a lot of the things I think make sense just don't work. They just don't test. They don't test good. And, that's the ultimate proof. And sometimes things that I think, oh, this makes tons of sense, the exact opposite actually works better. So, it's nice to have a reason because it gives you some confidence.
Yeah.
But at the same time, sometimes that's not always possible.
Yeah, yeah. So talking about those entries then that you've tested and perhaps have not worked so well or have worked the opposite, is there any that kind of stand out in your mind that perhaps have surprised you or given you the complete opposite result to what you thought?
Probably the ones that have surprised me the most are ones I program and it works, and I think, oh yeah, hey, I'm a genius, that what I thought would work, and then I go back a little bit later and find that there was a coding mistake, and it was actually, it works in spite of what I thought was going to work. For whatever reason, I made an error, and you could say, oh well, subconsciously you knew that it was greater than instead of less than. I don't know, but those are the weird ones where, and then of course you're left with, well, it works and it passed all my tests. What do I do with it now? And my tendency usually is when I see that kind of thing, I'll still let it prove itself in real time because, that's the ultimate test. You can do all kinds of back testing, out of sample, walk forward and do all that. But ultimately it's that live market that, there's no way you'd know what the data is going to look like. And if it still holds up, that's the ultimate test.
Yeah. Now, obviously you've tested a lot of entries for people who have a look in your book. There's quite a few in there. Now, you've already mentioned a couple of examples like moving average crosses or candlestick patterns and things like that. Have you found any specific type of indicators work better than others? For example, like indicators versus price action or chart patterns, are any more robust than others?
That's a good question. I guess in certain cases, yes, but in a lot of cases, no. So what do I mean by that is, like, for example, in the book, I probably have momentum, the close minus the close so many bars ago. That tends to be a pretty good indicator or measure, whatever you want to call it. RSI also tends to be pretty decent. And then on the pattern side, I've also seen some patterns that tend to work pretty well in different locations, different instruments, different bar sizes, so different time frames. But by the same token, there's always, with any of those, there's always a ton of places where it doesn't work. So, there's a lot of people who say, oh, hey, I need this to work on every single market. I always tell them good luck with that because it's just hard to find something that's a universal type thing. It's near impossible, and you'll pull your hair out doing it. But it is nice to actually sometimes have that validation where, oh, it works with the Japanese yen and it also works with crude oil. That certainly gives you more confidence in it, but I've never treated that as kind of, oh, hey, it's got to work in these different markets. Or at least I don't now. There was a time where I was probably more that way, but I realized it's just harder to find things. And, at some point you have to kind of balance, hey, how difficult is something versus how many systems can I create if I relax or just have slightly different standards. And again, either way, if you still prove it in real time, that's your true validation. So that's kind of the way I look at it.
And I guess as well, it probably comes into optimization a little bit because you're probably likely to have more parameters to optimize if you've got an indicator versus perhaps a pattern that has no optimized parameters. So I think that kind of goes back into the point you were making earlier about being careful about optimizing.
Right, exactly. Yeah, the really bad thing about indicators is you've usually got look back periods and thresholds for values, and they can all be optimized. And unfortunately, what a lot of people do is they think if it can be optimized, it must be optimized, and that's a terrible way of thinking. But we all, to a degree, fall for it, myself included. There'll be times where I have to catch myself and I'm like, wait a minute, I'm trying to do a little too much here. And I think that's just, as you get experience, you start to realize, hey, the less I do, the better. And, ideally you do none, but that's, for most of us, that's pretty unrealistic.
Yes, earlier you mentioned that you like to let your strategies play out a little bit just to see how they go in the markets. But if you just wanted to test the effectiveness of an entry, obviously there are so many different components to a trading strategy that can impact the performance of that strategy. Is there a way that you can test the effectiveness of an entry on its own?
Yeah, there's a couple ways I would do that. One way is to actually just try it with an exit where you exit after a certain number of bars. So let's just say you say 10 bars, and you just track how profitable the strategy was after bar 1, after bar 2, after bar 3. And that will give you a sense of, is it never profitable, or is it always profitable, or does it ramp up and then kind of die off, which I think a lot of strategies do. That would be one way to do it. What you'll find, unfortunately, is I think a lot of like entries will be profitable 1 or 2 or 3 bars after the signal. But the problem is when you factor in commissions and slippage, a lot of times, even though they're showing, hey, it's profitable, after costs are added in, they're not profitable enough to actually be worthwhile. So, there's obviously a persistence with an entry signal. It doesn't, if I get an entry signal today to go long, it doesn't mean it's good for the next year. But at the same time, those shorter periods of time, you have less time to overcome the slippage and commission, and that kind of kills a lot of entries. It's funny. I remember once doing a study where I looked at a whole bunch of indicators, and roughly they're anywhere 45 to 55% accurate over a certain time frame, with no costs added in. So some of them were good, some of them were not good. But when you added real trading costs into it, most indicators just lost money. They just weren't good. And that's not to say you can't then take a couple of them and combine them or use them in certain situations, but just means by and large, a lot of this is just kind of break even at best case, and usually losing after slippage and commission. That's what makes it so hard.
Yeah. So if you're doing this test of an entry and you see, so you're testing it over the following 10 bars, and you notice that the first 2 or 3 bars, it's not actually very effective, which you can often see, breakouts that pull back a little bit just after they've broken out before they move on. Would you then adjust the logic of the entry to take that into account, or do you think that's starting to get too close to curve fitting? Or how would you treat an entry if you saw it perform like that?
I have done that. So where I actually just built in a delay where I get the signal today, or this bar today, but maybe I don't take it until a couple bars later. I have done that at times, and I've kind of had mixed results with that. It didn't quite work out the way you'd think, where, hey, you delayed a couple days and you get rid of those first few bad days. It doesn't necessarily work that way, and I'd have to really dig into it to recall all the details about it. But I mean, that's something you could do. It just complicates it, and like you said, now it adds another a variable, at least one. So you have your entry, but then you have your delay on your entry, and so you're probably going to be able to optimize it even a little bit and get something better, but it may or may not work going forward.
Yeah. So what about then if you're building a strategy that goes long and short? Do you like to see symmetry in the entries, perhaps opposite logic or something like that? Is that something that you aim for when you're using specific entries?
Yeah, and that's in the book. Most of the strategies I have do that. I like symmetry only because a lot of markets can go up and down, and people can argue, well, hey, it should be different because the markets can collapse faster than they rise, and that's true to a degree on a lot of markets. But the only real set of markets are stock indices, where the symmetry probably doesn't hold as well. But even with those, I still like to have the symmetry, and if for no other reason, then it helps prevent me from curve fitting, because if I have let's just say it's a 10 bar breakout for long trades, and then it's, maybe it's only a 6 for short trades. Well, right there, I've doubled, now instead of one parameter, I've doubled my parameters. I have 2. And is it good? I don't know. Could it be curve fitting? You're starting to get closer there. So I always like to limit the amount of things, but unfortunately that means your back test doesn't look as good, and you don't get as excited about it. But that's just part of it. It took me a long time to realize that building a great looking back test was not the goal. It's just, it might happen, but if that's your goal, you're probably going to be disappointed, because in real time, you won't be disappointed in building the system, because you can create great looking back tests. I mean, that's fairly easy, but to do it, you usually make a lot of mistakes.
Now, what about, have you done any work in classifying entries in different market environments or different market conditions? So, for example, perhaps taking a breakout when the market is consolidating might not perform as well as when it's trending and retraced. So do you ever look at entries in the context of broader market environments?
I've, other than sometimes putting a filter on it to say, if price is above the 200 bar moving average, for example, then only take long trades, and vice versa. I'll do some of that, but the problem, once you start to break the market down into different regimes, like Van Tharp, for example, talks about, I think, 6 different market regimes, and he says, well, hey, just trade the system that works best in that regime. It's a great theory. I mean, it sounds really cool. Oh yeah, I'm only going to trade my volatile bull systems in a volatile bull market. Okay. But the problem is in setting up what is a volatile bull market, what is a range bound bear market, or a low volatility bear market. When does that get triggered? And so you end up having to spend a lot of time creating models that just describe what zone you're in. And usually, from what I've seen, people in bull markets are usually late by about the first 20%. So meaning they miss about the first 20% of a bull market, and then they stay too long. It's the you're having a party and you have some guests who arrive late and you don't like that. And then you have other guests who won't leave and, they stay way late and you want to go to sleep. That's, you lose on that end. So out of that 100% of that whole bull market move, you might have missed the first 20% and the last 20%. And so you're left with 60%. And it really isn't even that good because it's not like you just caught the 60%. Don't forget when the 20 in the beginning and the 20 in the end, you were probably the opposite. So not only weren't you in the bull market, you were still thinking it was a bear market at the time because your indicators or whatever measurements you use hadn't turned yet. So that's the big problem with it. And of course, now you've added a lot of complexity to your models by putting in this bull or bear overlay, and there's parameters that can be optimized and everything. And, do you benefit enough from that enhanced model to make up for it? Maybe yes, maybe no. My experience is I've tried it sometimes and it's never really helped that much. Others I'm sure would disagree and, maybe it's just the way I'm doing it, but, I'm always kind of leery of that kind of thing.
Well, up until now, we've kind of really focused on entries, but I'd like to ask you a little bit about exits as well. I think they're very important. And now, there's obviously some very common exits that people use, like fixed stop and target. But looking through your book, there's obviously a lot more to it than just the simple things, especially around using entry logic as exits. So can you share a little bit about what you found in your research with exits?
Yeah, that was kind of interesting. I had, I run an online workshop, but one of the things I did a little over, it'll be 2 years ago, I had some of those students flew into Cleveland, where I'm at, for a weekend of building systems. And one of the things we did was, obviously people could build entries, whatever you want, exits, whatever you want. But one exercise, I actually had them specifically use typical entry conditions as exits, not just stop and reverse, but just as an exit. So if, for example, if it was a 10 bar breakout high, normally you'd buy. Okay. Well, I said, well, make that an exit for any short trades. If you hit a 10 bar high, you just exit. You don't necessarily go short. And I didn't really know what to expect when I asked that, but what we found was some of the best exits were those entries, just configured just to exit a position, not necessarily to reverse or anything like that. It was just to exit. So, which kind of opens up the door for all the entries I have in the book. Hey, you can use those as exits too. Which then, people's heads start spinning, because then you're like, oh my gosh, now I got 52 ways to enter and exit, but then plus I got a whole bunch more ways to exit. But it's something I had never really done in my own trading, and based on what we found, there was a group of about 30 of us who did all kinds of testing on that weekend. I started to do that more in some of my own systems. And it's kind of been interesting to do that, kind of look at things a little bit differently.
So do you think then that the exits need to match the type of entry? So, for example, you're using maybe a moving average entry. Do you think it's wise to use a moving average exit as well? Or do some exits work better with some entries and not others?
Well, definitely some would work better than with others. But I can't say I've ever looked and said put a certain class of entries should only be used with these kind of exits. I've never gotten to that detail, but I mean, I've definitely found where some indicator-based entries, for example, could work with other indicator-based exits or pattern-based exits. You almost never know until you test it. And, I'd hate for somebody listening to think, oh, well, Kevin said never do this. My recommendation is always to test. Don't listen to me. Don't listen to anybody else tell you this is the way to do something. As far as, oh, you got to use this exit, got to use this entry. What I'm saying is test it yourself and verify it. And because I think all of us have bought trading books where we've tested ideas and the author gets one set of results and we get something completely different. And you're scratching your head. You're like, why? Well, hey, data is different. Especially with like futures with continuous contracts, or if you're trading with Forex, different brokers will have different data, and that could lead to differences. Yeah, and hey, maybe they're starting a different time. I once ran into a problem with TradeStation where somebody was getting results that were completely different than mine, and we finally tracked it down to how they were building their bars. They were building their bars based on time of day. So let's say they were hour bars. It would be 6 o'clock, 7 o'clock, 8 o'clock, 9 o'clock, top of the hour. But the way I was looking at it was based on session hours where it was 7:30, 8:30, 9:30. And you'd be surprised how much different a system can be when you test on one type of bar versus another. They're still 60-minute bars. They just started, they're a half hour offset. And so I always recommend that you test it for yourself. And if you have a solid way of testing and, you believe in your results, which means you've probably traded, or at least there's a way you verify that what you're doing is right. That's the best way to see for some of this yourself.
Yeah. Now, earlier you mentioned a technique we can use to test the effectiveness of entries just by looking at the performance over the next X number of bars. Can you also use that technique for exits as well?
Yeah, you could. I think the problem, though, it's probably more entry dependent. So, for example, if you just wanted to, you'd kind of have to work backwards, because a lot of people just use typical stop loss and profit targets, and that's kind of hard to do that sort of, bars back, or bars since entry kind of thing. I mean, you could do it. I can't say I've ever done it, and that's why I'm struggling with an answer here. And the other thing to keep in mind for everybody listening is you can test exits by themselves, you can test entries by themselves, but a lot of times what's really important is the interaction of the two.
Yeah.
I've had entries that look great with one particular exit and look terrible with a different exit. And then I think, oh, it's the exit, but that exit will work great with something else. And again, it's something you'll see when you start testing.
So what about combining different types of exits, say, a fixed stop and maybe an indicator-based exit and a profit target? What are the types of things you look for when you're combining exits, and is there anything that we kind of need to be careful of when we're combining different exit types?
The biggest thing to be careful about when combining them is just doing too many. You could have, I've seen people do this where they have a stop loss, and then they have a trailing stop, and they have a profit target, and they also have a break-even stop. And so, for each of those, you have different parameters you can set, and you can quickly overwhelm yourself with it. And what I've found a lot of times, the easiest, simplest systems tend to be the best ones. So a lot of systems I won't have a profit target. I won't have a trailing stop. I'll just have a simple stop loss. And that's it. Some of them I don't even have that. I just use the reverse of the entry. It's just a stop and reverse system. So I'm always in the market one way or another. Sometimes that works the best, but I'm always really cognizant of having too many things, too many parameters that you could optimize. Because even if you tell yourself you're not going to optimize it, oh, hey, I'm going to put this $500 stop loss, but I'm never changing it. You can tell yourself that at the beginning, but as you kind of go through and you're looking for ways to improve your system, all of a sudden that $500, what if I made that $1,500? What happens then? And it's better. Oh, well, how can, I got to use that, right? Because it's better now. And that's the biggest thing is your exits can be super complicated, but there's usually a price to pay with that. But I understand a lot of people like that because it goes back to having great looking back tests. Everybody wants a back test that looks great because they're putting their money on the line. And why put your money on the line with something that doesn't look great to begin with? And that's kind of the tough part.
Yeah. And I think one of the challenges with optimizing exits that maybe traders miss sometimes is that if you're, say you're optimizing for a specific stop loss, like a $500 stop loss or a profit target, sometimes the optimization process can actually just remove that one big loss or include that one big trade. And, it's not really impacting much else, but traders are making decisions based on these optimization results that perhaps aren't really robust because they're only impacting a small number of the samples. So,
Right.
Is that something that you look out for or that you've seen other traders kind of get caught out by?
Yeah, I mean, definitely you can get caught up with it. The way I tend to build systems, I kind of build in some safeguards to kind of prevent that. I don't want to say eliminate it because it's not something I specifically look for to say, oh, hey, when I change this stop, for example, how many trades did it actually impact? But I do know people who do that, and it definitely makes sense that you might want to take a look at that kind of thing. But yeah, it's not something I necessarily do consciously, but sort of the way my process is set up, it kind of accounts for some of that.
Yeah, and I guess as well, as you mentioned earlier, over time with experience, you kind of get a feeling for if you're going a little bit too far with this type of stuff, and you can rein it back. So,
yeah, and the good rule of thumb I always tell people is it's hard to know when you've optimized too much, right? But if you ever get to the point where you feel like maybe you have, or maybe you question, hey, maybe I've optimized too much. When you get to that point, you're already past it. When you ask yourself the question, you're already past it. And what I've found myself over the years is I start asking that question of myself a lot sooner than I did, 10 or 15 years ago. Maybe back then I was doing thousands of iterations, and now, if I'm doing 100, I'm still freaking out a little bit because I'm like, ooh, maybe 100's too many. And that's why I always love people who I got to get the fastest computer possible because I need to run these optimizations as quickly as I can. And my response usually is, maybe you're trying to solve the wrong problem. It's not computer speed that's your problem. Maybe it's the way you set everything up in the first place that you think you need that kind of speed. That's one way to look at it.
Yeah. I'm conscious of our time here, Kevin, so I'll just start wrapping up. So where can people learn more from you or even get in touch with you?
Sure. If you go to my website, kjtradingsystems.com, there's some contact forms there where you can email me and I'll get it. And also, there's a ton of stuff on my website. You can sign up for an email list, get some free material, a lot of webinars and that kind of thing. So I'm pretty easy to get a hold of. I'm usually hanging around some of the trading forums to either Futures.io or the TradeStation forum. I'm a TradeStation guy, so you'll see me on there. I'm Kevin K Dog is my nickname, I think, at both places. So, I'm pretty easy to get to reach if you want to reach me.
Yeah. And what about your book? I assume you've probably got some links on your website for the book.
Yeah, definitely. There's if you go to my website, there's a menu item that says my book or my books, and you can just click on that and read about my books. And there'll also be a direct link to Amazon. And for people who just want to go to Amazon, just search for my first name, last name, and up should pop a few books, and hopefully you'll like what you see.
Yeah, cool. Awesome, Kevin. Well, it's always great to chat with you, and once again, I've had a great time talking about entries and exits. Was there anything else that you'd like to mention before we finish up here?
No, other than just want to caution people that, especially with my last book, which just gives entries and exits, it's a good resource guide, but just don't go crazy with optimizing. I mean, don't think that just taking what I've done and just optimizing it like crazy on a whole bunch of different markets is going to get you the right results. You really have to have a good development process to use these properly. So that's probably the big key. So I just want to warn people about that.
Yeah, well said. All right, well, thanks a lot, Kevin, for spending time with us today. It was great chatting to you, and I wish you all the best for the future.
All right, well, thanks, Andrew. Thanks for having me on.
Cheers, thanks, Kevin. Bye. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.